Okay, I want to cover off on the importance of reducing your debt as quickly as possible and give you an example of a real life couple here in Perth. They are a doctor and a fireman and 3 kids and very busy with their everyday life. So in this example we show you how quickly we can turn their lives around by structuring their finances, reducing their debt as quickly as possible, and it wasn't with any strict budget or anything like that as well. And the good thing now, of course, is that now we can start looking at a timeline for when they can start building their wealth and investing in other property as well. So let me paint the picture here for you, and you'll start to see how we're able to turn this around for them. So they came to us and they had a loan of $364,000. They were paying a rate of 4.64 it was, and they were paying about $2,050 per month in their repayments. So it's going to take them about 25 years. So I've got a bit of an illustration here, but first I want to touch on the $2,050, and if we can imagine that as a brick. Now I'll ask you, what length would you go to pick up that brick? How much time would you spend? If you spent 2 hours of your time, would that be worth a brick that's worth just over $2,000? So visually, if we can show you that over 25 years, if each of those bricks is worth just over $2,000, for this couple here in Perth, they had 300 of those bricks in front of them, like a wall in front of their own house. Until each of those bricks have been smashed and gotten rid of, the house isn't truly theirs. Okay, so let's put this in a bit of a visual concept. So we've got a brick that's worth just over $2,000, and we've got 300 of them for this couple. So 12 for each year, which is obviously 1 a month. We first looked at finding a better home loan, and we got one at about 3.73%, which that reduced, and that smashed about 39 bricks straight away for them. The next thing we did is we implemented their repayments to be fortnightly, and that was fairly straightforward and fairly easy, and that got rid of another 22 bricks. Now, the other thing is, when I went through their budget, I found some surplus. In fact, I wouldn't even call it surplus. They were wasting money on an insurance that they would never have got paid. So by looking through your budget and finding a little bit of surplus, they were able to find very easily $100 per week. So we put that $100 per week to their fortnightly repayments, and that smashed another 50 bricks off their loan term. So you see, you can start getting some progress here straight away. We haven't quite seen the top of the house yet in this example, but you start to see what we mean by how many bricks we're able to get rid of, just with some time and effort and some restructuring. Now the last thing we did is we looked at an offset account. Now I don't recommend offset accounts for everyone, but for this couple we have, and we thought that probably on any given moment there's probably going to be about $10,000 in that offset account throughout the term of the loan. So that only works out to be another 6 bricks, but still 6 bricks at $2,000, most people will take that any day. So overall it was 117 bricks that we were able to get rid of for about an hour and a half of their time. Now can you start to see the importance of spending some time, taking a step back for a moment and really addressing the debt side of things, because the sooner that debt is paid off, the sooner the house is yours, the sooner you have freedom to be able to travel more, spend more time with your children. Maybe you might want to turn that hobby into your business, or resign from your own job and be more self-sufficient financially. Whatever your goals are, they start becoming a lot closer to reality by just focusing on reducing that debt as quickly as possible. So I hope that's given you a bit of an example of this couple here in Perth that we're able to help, and maybe some of these principles could be relevant to yourself as well, and maybe we could implement similar principles in your finances and your banking structures as well. Hello, the next thing I want to talk about is loan structures. And there's lots of different types of loan structures that we can do for a client. And it depends on your current circumstances and of course what your future plans are as well. But there's another thing that goes along with that we like to use, and it's based more around the psychology of how we think as humans, I guess. And it's just trying to give us smaller goals, bite-sized pieces. It sort of motivates clients a lot more. So I'll give you an example of what I mean by that. If we look at your actual home at the moment, let's say you've got a loan against that home. If we know that you're wanting to build your investment portfolio at a later date, as an example, or a share portfolio at a later date, we'll do a bit of a discussion around what you think that value might be at a future time. So let's say you plan at some stage in the future to purchase an investment property, and let's say a value of $500,000. Now obviously things can change and circumstances can change, so we allow for that, that's fine. But what we want to do is on your existing home at the moment, when we refinance or take up a new loan, we'll look at splitting those loans, and I'll call them here Loan 1 and Loan 2. Now, the Loan 1 will take the majority of the debt against your home. Loan 1 will be a smaller amount, an achievable amount, and what I tend to aim for is around 20% of your future investment. So in this example, if you're planning to perhaps buy an investment property worth $500,000, then obviously 20% is $100,000. Now, the reason why I like to do that is because then you know that that's your main aim. We have your offset account if you've got one, any tax returns, any extra funds that you have, we put into that loan too, and we get that down as quickly as possible. The moment you get that down to zero, then that's your trigger point. That's when you know, okay, this is our deposit, we can redraw up on that, that'll go towards the investment property. And then you can borrow the balance, obviously, against that property itself. So that starts telling you when is the right time to start purchasing the next property, and also manages the debt levels better as well. Now, the thing I love about this concept is we're not relying on the property markets to increase. If they increase, great, that's an added bonus, fantastic. We can readjust the sales accordingly. But this is not reliant on that. So that I find allows for clients to say, okay, that's our focus, let's get that down. For some people it'll take 5 years, some people will take maybe 2 years, some people might take longer, but at least you know what that focus is. So we like to always think a few steps ahead when we structure your loans, and as you can see, there's a good reason for that. So I hope that makes a bit of sense around how we approach loan structures and how that can benefit you over the long term. Okay, the other thing I wanted to cover off on was give you a bit of behind the scenes as to what goes on, so that you're in a position to put yourself in the best position to purchase the next property or refinance, and also get yourself to a stage where you're then buying the next property as well. So there's a couple of things that you need to be aware of, and there's 3 common questions that I get asked all the time from people is, can I get the loan? What's how long it's going to take, and what are my repayments likely to be? Now, can I get a loan? That relies a lot around first off your income and where that's coming from. And this is why, as a mortgage broker, we deal with quite a few lenders so that we can look at various scenarios for various situations. So some people are self-employed, some people haven't done their tax returns, but to put yourself in the best position, the lenders like stability. If you're self-employed, you need to make sure your BAS returns are up to date and your tax returns are up to date. This is to put yourself in the best position. If you're relying on some rental income, ideally that rental income is coming from a house in the suburbs of a major city. If it's regional or if it's an apartment, they're less likely to use as much of that rental income. So these are all things that you need to be aware of and have a chat about before you go buy the next property. Get your finances right. As I mentioned, around the security side of things, so the lenders look at the security that they're borrowing against. Now, they're very comfortable again with a suburban house that's fairly close to the city. Again, the further you go out in regional, they'll borrow a lower amount, and apartments, they'll borrow a lower amount, especially if the square footage gets less as well. So that's something to consider before you go out, and also, of course, having a good credit history as well is important. How long will it take to get the loan? Now, this is important to know when you're putting in an offer and acceptance, because you've got to put on the paperwork how long before pre-approval, or how long before a settlement. And you need to have this information up your sleeve because it can be used as a negotiation point. And it can be used very well. If someone wants a quick settlement and you know you've got everything sorted out in the background, then this can be used to your advantage and means that you might get that house as opposed to the next person. Now, lenders can vary. I've done a bit of a snapshot here, which I'll show on the screen, but lenders can vary. When I checked this the other day, from 24 hours to get someone to a pre-approval to 12 days. Now that's a massive difference, but that's just the way the workload is and all the rest of it with different lenders. Some lenders can just jump on it and do it straight away. Others, by the time they look at it and pull it out of their inbox, it's taken them 12 days. So we'll look at that, and depending on your circumstances, to get pre-approval, that may determine what lender's being used. Now, the last thing is about repayments. Again, the importance of using a suite of lenders is that repayments can vary greatly between lenders, obviously depending on interest rates and fees and everything like that as well. And I've got a bit of a snapshot here as well. The difference between, I've just based this on a loan of $450,000 over 30 years, and the cheapest repayments is $2,179 per month. And if we go down to the most expensive monthly repayments for the same loan, the same term, we're talking about $2,891 per month, all for the same loan for the same term. So each of those lenders is a reason why they have higher repayments. They might be putting on more risk. They may be more suited to self-employed or someone who's got poor credit history. So there's a reason why we have that suite. But if you've got the wrong loan and you're paying too high an interest rate, then in this example, that's a difference of $712 per month. Now, if that $712 went onto this loan that I was just referring to, of 30 years, that will reduce a loan by 11 years, right there. So by that extra saving that in this example of not having an expensive loan and putting that same repayment into the cheaper loan, they've just saved themselves 11 years. So this is another reason why you want to look at that as well. So that's something that gives you, hopefully that gives you a bit of behind the scenes as to what we see with regard to determining what lender to use for a client. It's only sort of a little snapshot. There's quite a few other phone calls and various emails that go back and forth to try and get the deal for a client. But it gives you a bit of an idea to position yourself, and hopefully highlights the importance of why you'd sit with us first before you go out and purchase your property. So I hope this video has helped you, and hopefully it's given you a bit of information as to not just about behind the scenes, but also a real life example of a client here in Perth, and of course how to perhaps structure your loans and your banking as well. We're offering a 20-minute phone conversation with you, no obligation. There's no hard sell. It's a free consultation over the phone to chat with you and your position and give you a bit of guidance around what should be your next move. So if you'd like to take advantage of that, please click on the take advantage of our offer, and we'll be more than happy to book in a time to have a chat to you for about 20 minutes. As I said, there's no obligation, no hard sells. We're not here to be doing that. We just want to touch base with as many people here in Perth as possible to help you get you on the right path. So I hope you take advantage of that and look forward to hearing from you.